Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, February 3rd, and I'm recording this from my office in Purchase, New York. The past several weeks have seen the S&P 500 trade in a tight range against the backdrop of higher interest rate volatility. Year to date, the index is up about 2.6%, lagging behind gold and silver, European equities, and U.S. financial sector. Certainly, after a torrid two-year stretch where the index has gained around 70%, the stall in momentum may just be due to technical consolidation. It is also understandable if there is just some market hand-wringing over the transition to a new administration in Washington. Our read, however, is that something more fundamental is afoot, something that challenges the bullish narrative that has endured since October of 2022. Remember, that storyline behind the momentum has been simple. The Fed will cut interest rates consistently, executing a perfect soft landing amid U.S. exceptionalism in generative AI and mega-cap tech dominance. But this narrative may have received a knockout blow last week, ushering in a period that we're calling the Great Normalization. Consider first the implication of last week's Fed meeting, where policymakers hit the pause button on rate cuts. There was also no mention of a curtailment of balance sheet reduction or a change to quantitative tightening. This combination, in our view, strikes a nail in the coffin of any hopes that rates will somehow not stay higher for longer. Investors need to recognize that with estimates for the terminal rate having moved higher and now solidifying closer to 4%, valuation expansion also is nearing its limits. What this likely means is that from here, advances in the S&P 500 index can only happen from actual earnings growth. And as we've noted, we believe 2025 profit growth is likely to come in closer to 7 to 10% than the 12 to 13% forecast, which, as we've noted, strikes us as too ambitious given recent history. The second development arguing for the Great Normalization is the news around Chinese AI developer DeepSeek and its cost-competitive offering in generative AI. While we have limited insight into the viability of this application, it serves as a reminder that technology itself has a way of constantly reinventing itself. The tech innovation cycle is racing ahead, and the phase of hardware and infrastructure dominance may be maturing, with the focus now shifting towards software and applications, dynamics that undermine a U.S.-only dominance. These factors may cause the S&P 500 to deconcentrate away from the Magnificent Seven, with new AI leaders potentially emerging in business services, in software, healthcare, and financial services. So looking ahead, this normalization is likely to play out across at least three levels: a resetting of interest rates and equity valuation, a refocus on earnings growth as the main driver of stock prices, and a deconcentration of indices towards new leadership. With all this in mind, we would consider adding cyclicals like financials, energy, domestic manufacturers, and consumer services to your U.S. stock positions. But also think about diversifying your portfolios, adding credit and spread products, real assets, select hedge fund strategies, preferreds, and even emerging market debt. Thanks for listening, and for more information on portfolio strategies and financial planning, please, as always, reach out to your Morgan Stanley financial advisor.